The Consumer Bankers Association is pleased to welcome you to today's webinar, New Insights from FICO Resilience Index Research, an early adaptation identifying borrower resilience informed strategies across the credit lifecycle, presented by FICO. My name is Jenny and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and the participant lines are all muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunity at the end. You may submit a question at any time by entering the question in the Q&A box on the bottom of your screen. As a reminder, the views expressed by this webinar are those of the presenters and do not represent the views of CBA or its members. It's my pleasure to now introduce our speaker. David Binder is a senior principal consultant with FICO Scores team, supporting clients in adoption of new solutions with the current focus on FICO Resilience Index, available at all 3 major US credit bureaus. Welcome, David.
Thanks, Jenny, and thanks everyone. It's really great to be here, and I appreciate your time. Hopefully we'll have a good interactive session. I know Jenny gave guidance about how to submit questions. I will glance at those questions throughout, and if I see one that's particularly timely, I might go ahead and try to answer it in the middle of the presentation, as Jenny said. Otherwise, there'll be plenty of time for Q&A at the end, I hope. And you'll see the poll question. There'll be another one later in the session, but this is just a warm-up. So it's asking when you expect to see rising delinquency and default rates due to the pandemic, or do you not expect to see rising delinquency and default rates, given that we haven't seen them emerge in great numbers so far? So we'll just leave another 10 or 15 seconds for voting. If you have a chance, please take your pick, and then I'll summarize and kick off. Okay, so split about 50-50. Those who responded are expecting about half are expecting by the second half of this year, which is coming soon. The rest expecting by either you're not sure or by the first half of next year. So interesting to me that nobody selected never. So I think that shows some good caution. But we definitely have been speaking to a number of lenders who are beginning to wonder if actually the pandemic will have an effect on delinquency and default rates. And when we talk about the use of FICO Resilience Index and embedding knowledge about borrower resilience in strategies across the credit lifecycle, we'll not only talk about how to apply it in times of stress or anticipated stress, but also in more benign times or times of recovery or anticipated recovery. So one of the messages that we want to convey about FICO Resilience Index is that although it happened to be introduced to the market just coincidentally as a pandemic introduced a huge amount of uncertainty to the economic environment, it is really an always on kind of tool that we see value. We see adding value through all stages of the economy and really across all parts of the credit life cycle. And that's what we'll try to inform you all about today. So it's clearly become now a cliche to talk about today's unprecedented time. So I promise that's the only time I'll use that phrase. And it's a bit tongue in cheek. You know, really the impacts of the pandemic started to emerge really rapidly in the US just over a year ago. And, you know, clearly many lenders have learned to adapt to the effects of COVID-19. But I think it's still fair to say that the ongoing economic disruption has presented unique challenges, and those challenges have required and continue to require coordinated efforts across the business to formulate the response to this drastic and unexpected change to the environment. And more generally, during periods of economic stress, there's this tension that arises between the imminent need to contain exposure to credit losses or potential credit losses, and the desire from a business standpoint and a customer standpoint to safely acquire new business and to protect the long-term health of the enterprise. Now, we acknowledge that lenders still haven't really suffered significant credit losses due to the pandemic, but it remains uncertain how long consumers can continue to weather this disruption, even with support from government and lenders. So one way that lenders have traditionally managed this trade-off between portfolio risk management and business growth is by adjusting cutoffs in decisions that use credit risk scores, such as the FICO score. And we think this is a reasonable place to start, and particularly given the known behavior of FICO score during stress periods. So it's important, I think, an important reminder that the main job of the FICO score is to rank order credit risk at all stages of the economy. So in general, regardless of what's happening in the economy, a higher FICO score represents a lower credit risk, a lower FICO score represents a higher credit risk. But we know that the actual repayment odds, or if you prefer, the probability of default associated with any given FICO score, that changes with the economy. And in general, it worsens during periods of severe economic stress, as conceptually illustrated here. So the solid line on the top is the relationship between repayment odds on a log scale, so it's a straight line, but between repayment odds and FICO score. And the dashed line represents that same relationship, but during the Great Recession or other severe economic recession. So across the FICO score spectrum, the odds worsened, but the rank ordering continued to hold. Now, a senior executive from one of our clients challenged us with a question. They said, well, which of my, say, 680s will go bad in the next recession? Or put differently, within the 680 FICO population, or the population really at any given FICO score, but respecting the example, is there a way to identify consumers who are more or less resilient to economic stress than others? Our research, of course, revealed that the answer was yes. We leveraged credit bureau data, the same credit bureau data that we use to build FICO scores, to define a measurement of consumer resilience to economic stress based roughly on how similar consumers behaved through two different phases of the economy. The first being the Great Recession of 2007 to 9, and the second, contrasting economy, being the benign economy of 2013 to 15. And based on this measurement, we observed that the most resilient consumers within a FICO score band consistently and significantly outperformed the average consumer in that same band during the Great Recession. And similarly, we found that the least resilient consumers significantly underperformed. So more generally, across all FICO score bands, or a wide range of FICO score bands at least, across different products and different life cycles, account management versus account origination, for example, we see that more resilient consumers outperformed less resilient consumers, even within narrow FICO score bands. So even though they had similar FICO scores, they performed differently under stress. So that research led directly to the development of the FICO Resilience Index, which was actually introduced to the market last January or last year, and which is now available in production at all three major US credit bureaus, Equifax, Experian, and TransUnion. So FICO Resilience Index, or FRI for short, helps identify the latent credit risks within consumer lending portfolios that manifest during stress periods of the economy. So it's a different kind of metric. It's identifying something that is not easily identifiable during benign periods, but which emerges and differentiates performance even within similar FICO score ranges during periods of economic stress. So it's a rank ordering tool of sorts, but it rank orders resilience to economic stress rather than credit risk directly. It works in conjunction with a FICO score, and it's generally non-correlated at an overall level, which means that there's a wide range of values of FICO Resilience Index at any FICO score band. So importantly, it's not an independent measure of credit risk. It really needs to be used in combination with FICO scores because it's seeking to differentiate performance within narrow FICO score bands, specifically during periods of economic stress. So because it's a different kind of metric and to emphasize its independence from FICO score, it uses a different score range and it has different directionality. So FRI values range from 1 to 99, where lower is better or more resilient, as you can see. It offers an additional dimension of credit risk, therefore, that adds insight to portfolio risks at all phases of the economy, not just during or entering downturns. Since FICO Resilience Index doesn't behave like a traditional credit score, it can't be validated. Its performance can't be validated the same way we would validate performance of a traditional credit score. So it's capturing this latent risk that differentiates performance within narrow FICO score bands as a period of stress emerges, and therefore we can only validate that it's effective through such periods of emerging stress. So prior to the pandemic, the last period of serious economic stress was the Great Recession. So we had to go back to 2007 to 9. And really, when we talk about validating FRI, we have some guiding principles. We've actually formalized these in a paper that's available. But some of the principles are laid out in the example here. So we would normally score a population with both FICO score and FICO Resilience Index at the same time, ideally just prior to a period of emerging economic stress, and then measuring the serious delinquency or default rates over a performance window that's long enough to allow that portfolio's latent risk to manifest as a result of the stress. So it's important, we think, we're showing 24-month performance window here. We'd recommend for this sort of validation not to go less than 12 months, because normally you need time for the economic stress to emerge. We need then time for the economic stress that has emerged to affect customer payment performance. And then we need enough time for that performance to reach at least 90 days past due. So in a normal validation such as this, through a downturn such as the Great Recession, we'd ideally be looking at around the 24-month performance window and not shorter than 12 months, using a performance measure of 90 or more days past due or other derogatory event. We scored this population in October 2007, so before the impact of the Great Recession was starting to affect consumer performance, and carried it for 24 months to October 2009, so really covering the worst of the Great Recession. We also take different views of this depending on the industry and the life cycle. So you can see in the title, this is a view of personal loan account holders and really new accounts. So this is what we call an account origination view. So it's accounts that opened within 6 months after the score date of October 2007. And then we track that cohort through to October 2009. So now what are we looking for? Well, we're looking for FRI's ability to rank order credit risk within those narrow FICO score bands. And we see that here. So you'd look for this monotonically increasing default rate as measured by the height of each column. And as you move from left to right, you're moving from lower FRI values, so more resilient FRI values, to less resilient FRI values, such as you see on the green columns on the right. The other thing that we look for, besides that rank ordering, is significant differentiation in performance between what you see in the least resilient quintile, which we'd expect to have the highest default rate, and the most resilient quintile within any FICO score band. So if we use the 660 to 679 FICO score band as an example, we see both perfectly monotonically increasing default rates by FRI quintile. So quintile means we've just taken the population in that FICO score band and defined FRI value cutoffs that endeavor to cut that population into 5 equal slices after we've rank ordered them by FRI. And now you can see the 20% most resilient had a default rate of just 3.2% compared to the performance of the 20% least resilient, which had a default rate of 7.9%. So this represents a significant range of outcomes within a seemingly homogeneous FICO score band. And we can see this pattern hold pretty steadily across the entire range of FICO scores that we show here. It's quite common when you look at many of these charts, as I have had the pleasure of doing, it's quite common to see the absolute differentiation. So just one top value minus the lowest value being the highest in the low FICO score ranges, but the relative differentiation, meaning top divided by bottom, being the highest in the high FICO score band. This is just an example. As I said, we look across a number of industries, typically not just personal loan, but bank card, mortgage, and auto finance. And we'll also look at account origination and account management. We might then take a general view that looks at the consumer level. And however we've looked at it, we see the effects of FICO Resilience Index and its ability to differentiate risk through this period of economic stress. Another way that we analyze these charts is looking horizontally. So we're kind of looking, when we think about applying FICO Resilience Index to decisions, we think about it in terms of swap sets. So how might we make a different decision using FICO Resilience Index versus just using FICO score, among whatever other attributes might feed into that decision? And what populations might we want to swap in or swap out of that decision? So if you look horizontally, you can see actually that resilient 630s, I'm just kind of choosing the middle of this range, these resilient consumers here actually had lower 90 plus days past due rates than the most sensitive 710s during the Great Recession. So again, this is the personal loan account origination view. So that is a really significant shift in performance, and would encourage you to define cutoffs, not just based on FICO score, but on a combination of FICO score and FICO Resilience Index, which is something I'll illustrate later on. It's important to know what FICO Resilience Index is not designed, expected, or intended to do. So it does not provide additional rank ordering in the absence of stress. It's not intended to do that. So when we take that same personal loan account origination view and we measure the default rates, firstly, you could see that generally across the board, the default rates improved or reduced for any given FICO score range. So I'll just flick back and forth so you can kind of visually see that. And that's consistent with the message I gave earlier about the changing odds to score relationship through different periods of the economy. But you can now also see that FICO Resilience Index is not providing any consistent rank ordering. So in that same 660 to 679 band, it's almost completely flat. It almost has a tiny bit of reverse rank ordering. In others, it's up and down, kind of random patterns as you look across different FICO score bands. This is typically what we'd expect to see. So it's a key feature of FICO Resilience Index as compared to a traditional credit risk score. It is still working. It's still continuing to rank order resilience through benign periods, but the effects of that differentiation in resilience level only manifests as you go through a period of economic stress. So we developed FRI by comparing the performance of really similar consumers that experienced two different economies, the benign 2013 to 15 economy and the stressed 2007 to 9 economy, as I said. And therefore, the pandemic economy, the COVID economy, was really the first period of stress after that that would have allowed us to do kind of an out-of-time validation of FRI's effectiveness. But of course, through the various interventions by lenders and by government, we didn't really see delinquency and default rates emerge in great numbers, as we started off this presentation talking about. And instead, we saw much larger than average numbers of payment accommodations. So through the CARES Act and through often quite proactive outreach and reactive receptivity of lenders to requests from consumers who said that they were facing COVID-related challenges, there was a significant uptick in accommodations. So in the absence of normal delinquency and default numbers, we sought to determine whether FRI would provide rank ordering of these accommodations. In the logic being whether it's consumers reacting to an offer made or requesting help, it's sort of a self-identification of by consumers, by borrowers, that they might need some support, that their situation was tenuous, either because they had lost income or were facing health challenges or other unexpected expenses related to this, or they're running a business. Whatever the reason, this disruption led to this large increase in accommodations. And as you can see from the chart here, FRI continued to rank order, but now using accommodations rather than delinquency. And interestingly, we saw this pattern because the accommodations didn't, the pandemic, the effects of it were so sudden, and the action taken by lenders and governments was so quick that most of these accommodations had happened within about 6 months after the very beginning of the pandemic. And so, following the validation principles that we laid out earlier, we scored consumers as of January 2020. So again, before the effects of the pandemic were impacting customer performance. And this particular chart looks at the presence of accommodations as of October 2020 on mortgages. And this is looking at both new and existing accounts together just to get enough numbers. And you can see that differentiation. You can see that resilient 650s had lower payment accommodation rates than sensitive 710s. So that checking that horizontal test, as well as looking for the rank ordering and the differentiation that I mentioned earlier. So it's kind of ticking all the boxes. And it's remarkable actually that we were able to see this pattern emerge in a much shorter than normally recommended performance window, which is the point I was getting to. And we even saw this pattern when we first did the analysis in July 2020. So really just all within a period of 6 months, we were seeing this differentiation as payment accommodations really came into full force so quickly. So we're continuing to monitor this, and we're going through this interesting transition where, of course, the rate of new accommodations slowed dramatically. And many consumers who had been on accommodations have rolled off of them. Some of them, of course, are longer term, and we're not seeing this pattern emerge through every industry. But one of the things we'll look at later is for a card portfolio, what happened to those consumers that were in accommodations and then came off of them? Did we start to see differentiation in their ultimate payment performance as well? So we'll share those results later. Another way that we looked at this was by taking consumers who were actually already delinquent following the Great Recession, and to see if FRI, although it isn't designed to do this, we wanted to see if FRI did a good job at differentiating those consumers' ability to recover or to bounce back from delinquency. So you can see that this chart, although it has the same kind of format, it's got two very different features, well, three really. The first is we're using a very different performance measure. So we're calling it the non-delinquency rate for short, but what it really means is everyone is delinquent at the beginning. So at the score date, everyone's delinquent here, at least 30 days past due on at least one trade. As of October 2010, so kind of at the start of the recovery following the Great Recession. And the non-delinquency rate is the percent of those consumers that had no delinquent trades 1 year later. So because of that unusual performance measure, we're actually looking for reverse rank ordering rather than rank ordering. And then the last unusual feature, besides the relatively short performance window, is that we're looking at a subset of the FICO score spectrum that's really significantly skewed towards the low end. And that's because this is a population that's all starting with at least one delinquency. So, just for context, about just over 40% of this delinquent population resides in the 300 to 539 band. And this range that you see here that goes up to 659 represents about 95% of the delinquent population. So it's really hard to have a high FICO score with a current delinquency. So that generally shouldn't be surprising, but maybe the amount of concentration towards the left side of this chart is a little surprising. And it's important because the performance of this measure is strongest as FICO score gets lower. So in this really low FICO score band where 40% of delinquent consumers reside, we could actually see that the recovery rate or the bounce back rate from delinquency, the non-delinquency rate, was about 2.5 times higher in the most resilient quintile versus the least resilient quintile. So the point of this is that we continue to evaluate FRI's applicability in different use cases and different parts of the credit life cycle, and to validate its performance and evaluate that performance in different ways than we'd originally intended, and making some really interesting findings throughout this process. So now let's talk about how we might introduce or incorporate FRI into lending strategies. So we'll start with a conceptual diagram. So at a really high level, since FRI is a complement to FICO score, we're talking about, we'd recommend exploring use cases where FICO score is already used. And we know that FICO score is typically just one of a number of attributes or decision keys that goes into a decision. But we're saying to zoom in on the part of that strategy where FICO score is used and where cutoffs, in this simple example, we'll just look at a binary cutoff. So above that cutoff, credit is expanded or at least not tightened, and below that cutoff, credit is tightened or at least not expanded. So think of it as a horizontal line with no explicit differentiation by consumer resilience. In contrast, if you incorporate FICO Resilience Index, it now becomes a two-dimensional decision where you're looking not just the FICO score on the vertical axis, but also FICO Resilience Index on the horizontal. And it effectively turns that horizontal cutoff into a staircase. And the implication of that staircase is that you end up with swap sets. This area here, this darker blue area between the dashed line where the old cutoff was and the solid line of the staircase, is a swap-in population. These are people who, or consumers who, are now included in the credit expansion strategy, and their FICO score is below the old cutoff, but they are highly resilient. And so they are included in that credit expansion strategy. And then conversely, at the other end, you end up with a swap out population of consumers whose FICO score would have met the previous cutoff, but whose FRI indicates they are sensitive and, at least for this decision, should be swapped out. Now, this is again, a binary example, kind of a yes, no, like a pre-screen or application approval or decline decision. But you can apply this principle to more stratified decisions and think of these as different tiers in the strategy, where each tier might be defined currently by a FICO score cutoff. And we'll again talk about turning that into a staircase, and I'll illustrate that later. So we envision FRI use cases across the consumer lifecycle, from acquisition to account management, including at least early stage collections. Really anywhere FICO score is or could already be used. So at acquisition, we see that we could refine pre-screen decisions, underwriting decisions, pricing, initial loan or line assignment decisions, account management. We see a lot of relevance in the credit risk space and a lot of interest and early uses of FRI in credit line management. So kind of dealing with the exposure that was already on the books and managing the level of that exposure and any changes to that exposure as you continue to manage and refine the shape of that portfolio. And at least for collections efforts, you're really looking for ways to prioritize and direct scarce resources away potentially from resilient consumers who might be more likely to recover on their own or with minimal intervention, and towards less resilient consumers who might benefit from earlier or more assertive interventions. So when we look at early adopters, as I said, we're seeing a lot of emphasis on credit line management. We're seeing a lot of interest and emphasis on pre-screening and also early stage collections. But really every use case that's laid out here, we've had at least some conversations with interested clients who are still considering and evaluating FRI and how to implement it, incorporate it into their strategies and their systems. And so this broad range of applicability we are seeing in real life through the conversations that we're having with clients. And what I think has been quite interesting is the mindset has been, even when using FRI as sort of a course exclusion criteria, the view is not to think of it as excluding consumers from strategies, but rather allowing the strategy to run at all. And so it's more of an inclusion criterion. So that was interesting. As we went through the most uncertain times of the pandemic, we saw a number of lenders, really sharply pull back or even stop credit line management, credit line increases altogether. Whereas some of our clients who've been using FRI have narrowed the scope of the population that's eligible. And again, with credit line management, it's less of a no and more of a not right now kind of decision. And so, looking at ways to continue doing that to the most resilient consumers that meet the FICO score and other criteria of the strategy has been really helpful. And of course, now as attitudes start to shift and some of the concerns, some lenders are, starting to bet on, continued recovery, then they're thinking about how to refine the implementation to make that a bit less restrictive. And so, being able to tune these cutoffs and tune the implementation has been particularly important. Okay, so let's use credit line management as an example. So we can take the simple decision and we'll just summarize it. I know this isn't 100% realistic, but for the sake of an example, it's I think a useful illustration. So imagine you've got a strategy that's simply stratified by FICO score, where the highest FICO score consumers qualify for the largest credit line increase. Then the couple of tiers below that qualify for smaller increases, then a pretty wide range of FICO scores wouldn't get any change, and then lower FICO scores might qualify for a decrease. So this is sort of a series of horizontal cutoffs. So if we incorporate FICO Resilience Index into that strategy, then it gives an opportunity to allocate additional exposure based not only on the credit risk ranking as measured by FICO score, but also on resilience as measured by FRI. And you can see how this these conceptual staircases can actually be applied to a real stratified strategy. So one principle that we'd normally recommend, at least as a starting point prior to doing more detailed and more refined analysis specific to that lender's portfolio dynamics, would be to say, well, anyone in this moderate range of FRI values, which we've defined as 45 to 59, kind of the midpoint, the middle of the range, where, because the distributions tend to be bell-shaped, that's where often half or more of the consumers or the accounts in a portfolio might reside. So as a starting point, to get comfortable with the use of FRI, we might say anyone with a moderate FRI would get the current treatment. All right, so no adjustment to the strategy because of FRI values. But those who are more resilient would get a slightly more favorable treatment than they would otherwise. Those who are sensitive would get a somewhat less favorable treatment. And those who are very sensitive, which we'll define as the top of the range, 70 to 99, would get the most restricted treatment relative to their FICO score treatment. So again, it's all in the context of FICO scores. So someone with a very high FICO score who is very sensitive might, in this strategy, still qualify for some line increase if they had a very high FICO score, but otherwise, would either get no change or might even get a decrease. If they have a very high FICO score, in this example, the impact would be taking them from qualifying for the largest increase to potentially still qualifying for an increase, but a more modest one. So it's not even a no that's more like a not yet. It's a yes, but a less generous yes. It's more of a, we'll wait and see, reevaluate, but based on what we see today, there's enough information to qualify you for this size increase, and then you'd reevaluate and decide whether you can open up later if their combination of attributes improves relative to that point. So expanding on the diagram that we laid out before with the use cases across the credit life cycle, we also see this to echo and emphasize that always on idea. There are a number of activities that we're going to broadly call capital management that are ongoing activities whose outcomes might change depending on the economy and the economic outlook, but the activities themselves are sort of always happening. So whether that's loss forecasting or the related credit loss allowance calculations or reserve calculations, credit risk capital to protect against unexpected losses, stress testing simulations. These are ongoing, repeated activities, again, whose outcomes might vary depending on the economy and economic outlook, but whose intensity is sort of always present. And so, we're really looking at ways that you can use FRI across not just the credit life cycle, but through different economic environments. And the concept here is that, you would develop and refine portfolio resilience over time. And doing so really requires building resilience into these individual account and consumer level decisions over time to benefit from the cumulative effects of these granular decisions, with an eye towards a holistic concept of a risk appetite. So what do you want your portfolio to be able to withstand in the event of an unexpected stress or in preparation for an anticipated downturn versus, what do you want it to be able to achieve from a business growth standpoint? So again, that tension that we laid out right at the beginning, the tug of war becomes more interesting. Who's pulling harder on which side of the rope, I guess, varies depending on the environment. But this concept of building resilience into your portfolios to support your individual view of risk appetite is something that we think is an important activity to have ongoing, and this is an additional tool in the toolkit that can help provide a quantitative basis for such decisions. So when we think about the benefits of keeping FRI always on, it might seem more apparent through economic downturns, this ability to keep credit flowing with greater confidence to those more resilient segments of the population, to have that greater insight about that goes beyond just what FICO score and other traditional credit risk scores indicate about the stability and the resilience of your portfolio. Really limiting that loss exposure and doing so in a more refined way that's not overly broad, in a way that not only limits or hampers portfolio growth, but also affects customer relationships. So, how consumers certainly will remember how they've been treated through more challenging times, because if they're challenging times for the lender, they're probably challenging times for the borrowers as well. And, I think quite rightly, the industry has received pretty positive attention for how they've supported borrowers through this downturn. I guess in contrast maybe to the Great Recession, where tools such as accommodations weren't applied as broadly. And so it's an important customer service opportunity as well as a financial risk management opportunity. And part of that is right sizing strategies around both accommodations and collections. But as some start to think about recovery and growth, whether you believe it's starting now or whether you think there's still some rough patches to come, followed by a period of recovery and growth, it's natural to ask questions about, is FRI, is it still relevant? And we think it is, because it's like safety equipment in your car or insurance. These are protections that you hope you don't need to employ, but the value of having them is really clear once the situation demands them. So being able to build this resilience, objectively track it, observe trends, and see how it's affecting how you're managing it through different parts of the life cycle to better prepare the portfolio for future unexpected downturns is a crucial capability. It can sharpen your risk management in different areas, including early stage delinquency and authorization decisions, so really granular decisions, early stage collection strategies. When consumers miss payments, what does it mean? Is it the first step towards more serious delinquency, or is it a temporary setback influenced by the current economic situation that might quickly reverse itself as things recover? And there's a concept that we like to recommend that we'll just briefly describe as a two-layered risk appetite statement. And it might look something like, at say underwriting, a single layered statement might feel like, we will accept consumers with an expected default rate of X, in which case, as the view of the economy turns more benign, The differentiation that FRI would provide in a stressed economy disappears. And so it might be tempting to just make decisions based on what other risk scores are indicating. A two-layered risk appetite statement would say, not only do I want to book consumers with an expected unstressed default rate of X, I might also want them to have an unexpected stressed bad rate, not to exceed Y. And Y might be more than, might be significantly more than X. But adding that extra layer provides that protection against unexpected losses and demonstrates the value of FRI, because FRI would differentiate that expected performance under stress. I just got a question about what kind of factors would cause FRI to either increase or decrease. And what's interesting is, as I said, FRI leverages the same universe of credit bureau attributes that we use when developing FICO scores. But different attributes kind of bubble to the top in terms of their importance at identifying resilience versus FICO score. And it's through that we achieve this relative independence between the two variables. So at a high level, you can view more sensitive consumers as consumers who are simultaneously credit hungry today, so showing strong demand for credit through existing balances and recent inquiries and account openings, while also having a generally a lower than average or a relatively low level of experience with credit, as measured by either their length of history or the variety of credit products that they've had throughout that history. So, we were really pleased to bring FRI to the market last year. It just coincidentally timed, was introduced at a time when lenders were really concerned about managing risk and uncertainty in the portfolio. And as we've shown, it did prove effective at differentiating risk even through this current downturn, using a different and more appropriate performance measure. And we hope we've illustrated ways that it can provide value across the credit life cycle through different phases of the economy. But we did see an opportunity almost immediately to improve validation results, particularly for bank card originations, where we weren't seeing the strong validation results that would lead us to recommend using FRI in that particular use case. But more generally, across account origination life cycles, we thought that there would be an opportunity to improve performance. And so our data scientists, even as we were rolling out FRI, our data scientists set to work on a new version that we're pleased to announce today will be released at all 3 bureaus this summer. So FICO Resilience Index 2 will offer significant improvements in predictive power over the current release, in some cases more than doubling its rank ordering capability. It significantly improves account origination results, not just in bank card, but across auto finance, mortgage, and unsecured personal loans as well. And it even improved the already strong account management results that we saw across all industries. We are able to recommend the use of FICO Resilience Index 2 across an even wider effective operating range. So we'd said previously, and our validation charts kind of supported this, 600 to about 760 was the effective range where we felt confident that FRI, the current release, worked. We're expanding that range to 580 to 850 or even to 900 for industry options due to that significant improvement, and that provides benefits and improved coverage to both subprime and superprime segments. We're also seeing a broader distribution of values versus the current version, meaning you'll see more values at the extreme ends of the ranges, more consumers falling in those range, which will allow more refined decision-making. And it continues to be useful during recovery phases of the economy. So we did that recovery or bounce back analysis, but we're also seeing its ability to, an improved ability to identify consumers, even in this early stage, that are likely to successfully roll off of payment accommodations and avoid having serious delinquencies, and to differentiate performance based on the resilience of the consumer. So here's what we saw for account origination bank card. You can now see the consistent, monotonically increasing default rates within every FICO score band, strong differentiation between the high and lows. So this represented more than 100% improvement in rank ordering power as we measure it at FICO versus the current release for bank card account origination. And we saw 30 to more than 100% gains for the other industries as well. And for account management, which, as I said, were already strong, although the percent increases were smaller, they're off of a higher base. And so, the mortgage account management view, which was already one of our strongest performers, just is exceptionally strong in terms of the differentiation between the high and low within a very wide range of FICO score bands. And this was the analysis I mentioned a couple of times, the ability of resilient borrowers to successfully exit accommodations and have lower delinquency rates after doing so. So this is a population, they weren't in accommodations as of January 2020. They were as of April. They then exited those accommodations by July. So these are relatively short-term accommodations. And then we're measuring, because it's a short window to January 2021, we're measuring a 60+ delinquency rate because the counts when we switched to 90+ were relatively low. And we can see the rank ordering by FRI within these FICO score bands already. And we think the story is still emerging, even for bank card, but we particularly think it's going to take more time to tell this story for auto and especially mortgage, where the accommodations more like forbearance, more commonly were forbearance type accommodations that had longer durations, some cases mandated by the CARES Act, but in general, for those loan types, the duration of the accommodations tended to be longer. So we've just received data from April that will allow us to do, to update this analysis, and we'll continue to monitor it. So it's an evolving situation, and we're really looking for signs at every moment based on the data that's available that FRI is providing useful value through this very unusual economic situation. Just received a question that I want to answer. Actually, I'll answer that at the end if that's okay. So I just want to quickly lay out this timeline. So I mentioned it's expected to be available over the summer. So the exact order that we expect is it would be released at Experian in production by mid-June, in Equifax by the end of June, and in TransUnion early in the second half of this calendar year. So whereas the rollout of the current release spread over a number of months, this is going to happen all pretty close together. So by the end of this summer, FRI2 should be available at all 3 bureaus in production, and as different use cases become available, be able to incorporate it into different types of activities. So just to quickly summarize, a reminder that FICO Score's job is to rank order credit risk at all stages of the economy, but that the actual repayment odds for a given score do tend to worsen during periods of economic stress, that through our research, we identified segments that were more or less resilient than average to economic stress, that led to the development of FICO Resilience Index, which rank orders that resilience and differentiates credit risk specifically during periods of emerging economic stress, even within narrow FICO score bands. We've asserted and hopefully demonstrated that the use cases of FRI span the consumer life cycle, the full credit life cycle, and remain relevant at all stages of the economy. And as a complement to FICO score, really would be useful anywhere FICO score is or could be used today. And FICO Resilience Index 2, which will be released at all 3 bureaus this summer, offers enhanced performance, especially for account origination use cases when compared to the current release. So that's the end of my prepared statements and then presentation. I thank you for your time. I'll answer the question that is here, which is how dynamic or static is the change in FRI for a given period of measure for a consumer? Is the score generally more static than the FICO score? So we did actually analyze this. So because we wanted to understand whether when compared to FICO score, whether FRI should be refreshed more often than usual, less often, or at the same frequency. And the short answer is we feel confident that it should be refreshed as often as FICO score. We measured its stability on its respective scale versus the stability of FICO score. And interestingly, kind of saw, I'll call it an exchange rate of about 5 to 1. Meaning that for every point of movement of FICO score, or sorry, FICO Resilience Index, it corresponded to about 5 points of FICO score in terms of stability. So whatever percent of the population was likely to move by plus or minus 10 points of FICO score over a 3-month period you'd see a similar percentage move plus or minus 2 points. And then same for 20 versus plus or minus 4, and then same for 30 versus plus or minus 6. So I think that's it. We did have one more poll question, which we might end the presentation with. So Jenny, if you're able to just pop that on the screen and leave it as you close the remarks. But for me, I just want to say thank you, everyone, for your time and attention today. Please take a moment to respond to this question as Jenny provides some closing remarks.
Great, thank you, David. And with that, we must conclude today's program. The session has been recorded and will be available within 3 to 5 business days. On the behalf of the Consumer Bankers Association, thank you to our speakers, and of course, all of today's participants. Have a good afternoon, and you may now disconnect.